One of the things I am is a voracious reader. I love getting into books, but it's always about business and business modeling and understanding how business works, because it's just always been a passion of mine. And I would just finish the book called Understanding. It's called Understanding Michael Porter. Michael Porter was a great economist and business mind. He is still a great business mind. In his book, and I wanted to highlight something here, he goes into the concept of competition. And he says the key to competitive success lies in an organization's ability to create unique value. And it's a good competitive strategy, he goes on, good competitive strategy that will result in sustainably superior performance. And I could go on in a whole bunch of different areas on this, but let's talk about that superior performance. And so how does he calculate superior performance, and how does the market calculate superior performance? Like, for example, like Warren Buffett, when he's looking at a company, how does he know that that company has superior performance? Well, it comes down to this wonderful little ROIC calculation, which is return on invested capital. And so you might say, well, what does this have to do with an accounting practice? Well, other than you calculating it for your business owners, you should be thinking about calculating this for yourself. And so the basic calculation is this. It's the net income, annual net income minus any dividends paid in the year, divided by over the long-term debt and the equity. And so that'll give you kind of your return on invested capital. So how much capital have you put into this business, and how much is it making back for you every year? In an accounting practice, and I was going back and thinking about this with mine, and every firm that I work with, I look at the ROIC as well. What do we need the long-term debt for? Like, what's the debt? What is that made up of? And a lot of accounting firms say the partnerships, they have a partnership capital account. We'll call it PCC for now, partnership capital account. And that number can be really big. And why is that number really big? Well, it's basically the long-term debt part of it, or if you're not incorporated, it's part of this equity piece. But why does partnership capital accounts exist in the first place? Like, when you think about this, why is all the money locked up in your firm? Well, it's locked up because of the cash flow, the timing of cash flows. So when you have most accounting firms have a billable hour model, and so what they do is they build up this big WIP, and then they turn it into accounts receivable, and then eventually it turns into cash. That looks like A, but it's AR. So what happens is that you've got this huge partner capital account, which increases the denominator here, which then reduces the ROIC. So for most accounting firms, if you look at it, the ROIC is not that great when you look at the calculation. And so I've often said, in every accounting firm that I work with, I said, what would you do if you could get your partnership capital account out? Like, if you could just get that money out and then redeploy it, buy a house, buy a condo, or buy like a cabin on the lake for your family, or how about you just reinvest it somewhere where it's actually making you more money? And so what happens here is that it's all because of the billable hour. It's the billable hour that's the culprit here. Is because we have a timing issue. Is that we're working along, and we're building up WIP, and then we do an AR and all the rest of it. But at the same time, we're having to pay all these expenses. And that's why the partnership capital account comes in, and that's why all this debt happens in accounting firms. It's staggering how much I've seen in accounting firms. And I challenge you, or I offer it up to you, to take a look at your accounting practice, look at your balance sheet and say, okay, how much of your long-term debt is your partner capital account? So how much money do you have locked up inside your accounting practice that's just there servicing, or basically supporting, the WIP and the accounts receivable that you have in your model? So what I did in my accounting practice, I should say, is I changed over from this building up of WIP and then doing accounts receivable. I thought, this is ridiculous. Let's switch over to a value-based subscription model. And that's what the Accountant Success Formula program does, is it shows accounting firms how to transfer from the traditional billable hour model to the subscription-based model. And one of the wonderful benefits of this is that it frees up your partnership capital account. So what happened was my WIP went to 0. So for me, this goes to 0. The AR went to 0, and therefore the need to have a partner capital account goes to zero. And I've been seeing this happening in multiple coaching clients that I have where they've got 3 or 4 partners, and the one partner has switched over to the account success formula model. Their requirement for supporting WIP and AR is dropped down because they don't need the cash there because they've got all the cash front end loaded. So you front end load the cash so you're not having to support it. Ultimately, their ROIC is much higher. And when you think about it, if you're exiting your accounting practice, if you've got a higher I'm tripping over my words. If you have a higher ROIC, you therefore have a higher valuation, which is what Michael Porter talks about in his book, Understanding. It's what Warren Buffett looks at in any business. It's what is the ROIC? What is the return on invested capital? So if you are running your accounting practice on a billable hour model, and you have a high partnership capital account, and you want to unlock that cash and use it for something like I said, like family cabin, or redeploying the investment somewhere else, or just using the money so that it's actually making you money instead of locked up in your accounting practice, reach out and give me a call. I'd love to have a chat with you. So I'm Eric Solback, and wherever you're watching this, please scroll down, leave a comment for me, and stay tuned for more success tips to come.